Something happened in the silver market on May 6, 2026, that the financial press reduced to a 3-second scroll, a number on a ticker, and moved on. They should not have moved on. Because what moved on May 6th was not just a price, it was a pressure gauge reading on a system that has been building stress for months, and on that single Wednesday, 3 of the heaviest structural forces pressing down on silver's paper price shifted direction simultaneously, in a matter of hours, on a single Axios report about a 1-page memorandum with Iran. Silver surged 6.01%, gold climbed approximately 3%. The PHLX Gold and Silver Sector Index gained roughly 8% in a session, and spot silver, which had been trading near $74.52 on May 5th, punched up to $77.18 on May 6th, with the gold-silver ratio compressing from approximately 62.5 down to roughly 60.6 in a single day. If you understand why silver outpaced gold on a peace signal, not a war signal, a peace signal, then you understand something the Cable Financial Desk has not explained to you once in the past 2 months. Gold is a monetary instrument. It rises when people fear the dollar, fear inflation, fear the erosion of purchasing power. When a Middle East de-escalation signal arrives, gold's monetary fear premium fades. Gold should go sideways or down on peace news, but gold went up 3%. That tells you the dollar fell sharply enough on Iran deal optimism to drag gold higher through the currency channel alone. Now here is the part that matters. Silver went up 6%, twice gold's gain. Silver carries both a monetary identity and an industrial one. Solar panels, electronics, semiconductors, electric vehicles, medical devices. Silver is inside the physical machinery of the modern world in a way that gold simply is not. When silver outperforms gold on a peace catalyst, the market is not merely pricing out inflation fear. It is simultaneously repricing the restoration of the industrial supply chains that a Hormuz reopening makes possible. 2 months of war-driven energy costs had frozen those chains. The silver market moved 6% in a day because it was pricing 2 things at once: the same monetary relief gold was pricing, and the industrial restoration gold never had to price at all. Now let us go further back, because the May 6th move did not happen in a vacuum. It happened against a backdrop of structural data that has been assembling quietly since the beginning of the year, and which the Institute for Supply Management published in documented form on May 1, 2026. The ISM manufacturing report for April came in with a prices paid index of 84.6%, a 6.3 percentage point jump from March's reading of 78.3, and the highest reading since April of 2022. Over the prior 3 months, the prices paid index had risen 25.6 percentage points. The ISM chair's own documentation confirms this represents the largest 3-month surge in the index's recorded history. Simultaneously, the manufacturing employment index fell to 46.4%, the lowest print of 2026. The manufacturing sector is expanding output, exploding on input costs, and contracting on employment, all at the same time. There is a precise term for that configuration. It is stagflation. And this is not a projection, not a model, not a Wall Street forecast. This is a confirmed reading from approximately 14,000 individual survey respondents operating actual manufacturing businesses across the United States. The ISM Prices Paid Index measures the good side of the economy, and it feeds into services prices with a 1 to 3 month lag. That transmission has already begun. ISM services prices for April came in at 70.7%, a 4-year high, with the ISM chair stating publicly that prices would remain elevated for months even if the Iran conflict ended immediately. And here is why that matters for silver specifically. Silver's paper price on Comex has been suppressed since January's all-time nominal high of $121.67 per troy ounce, set on January 29, 2026. The metal has corrected approximately 37% from that peak, trading in the $76 to $77 range as of May 7, 2026. The mechanism for that suppression is the Federal Reserve, or more precisely, the market's expectation that elevated inflation prevents the Fed from cutting rates. Higher rates mean a stronger dollar. A stronger dollar means a lower paper price for dollar-denominated commodities. Silver has been living under that ceiling for 4 months. The ISM data is the most explicit confirmation yet that the ceiling is not just financial. It is stagflationary. And stagflation, output expanding, costs exploding, employment falling, is the economic configuration that historically forces a Fed capitulation on rates, not a Fed hike. That is, the structural tension beneath the May 6th move. and we have not even reached the part about what is happening inside the Comex warehouse system itself. If you have been watching this channel and you are not yet subscribed, and I mean genuinely not subscribed, I want you to think about what you just read in part 1 and ask yourself where else you are finding this level of sourced, documented primary data analysis without an advertiser, without a financial product to sell you, without a steered narrative. Hit that subscribe button right now, because what comes next in this script is the layer the financial press is not connecting. And if this channel goes quiet, you need to already be here when it matters most. The Comex registered silver inventory, the portion of warehouse stocks immediately deliverable against futures contracts, stands at approximately 76.88 million ounces as of May 1st, 2026. Comex open interest in silver futures sits at approximately 575.5 million ounces over the same period. That produces a coverage ratio of 13.4%, the sixth consecutive period this metric has printed below the 15% stress threshold. Translate that plainly, for every 100 ounces of paper silver outstanding on Comex, there are approximately 13.4 ounces of physically deliverable metal in the system to back it. Published Comex data shows roughly 6 times more paper than deliverable physical metal as of early May 2026. Now overlay what happened in January. In a single week, 33.45 million ounces were withdrawn from Comex registered inventory, approximately 26% of the entire deliverable pool disappearing in 7 days. That was the January 2026 delivery event. As of today, the registered inventory sits at 76.88 million ounces. The eligible pool did not refill. The leverage structure did not compress. The coverage ratio did not recover through the correction. And the May delivery cycle is active right now, applying fresh pressure to a registered pool that has not grown meaningfully since January's withdrawal. The bear case on this data point is honest and deserves acknowledgement. The 6-to-1 paper-to-physical ratio has existed in various forms for years without triggering a delivery crisis, because the overwhelming majority of Comex futures contracts have always settled financially, not physically. The ratio being extreme does not automatically mean the system breaks. What the coverage ratio does tell you is that the system has no buffer left. If delivery demand accelerates, and the May cycle is the test, there is no cushion. That is a different and more specific claim than predicting a delivery failure. It is a claim about the absence of margin for error. Now take that Comex coverage picture and lay it alongside something the English language silver desk has almost entirely missed. Japan's secondary retail silver market, specifically the consumer resale platform Mercari, has at times seen premiums on physical silver surge to approximately 60% above the published Comex spot price. Not 12%, not 15%, 60%. The Shanghai premium, the premium Chinese buyers pay for physical silver above Comex spot, has been cited in precious metals coverage for months, running approximately 12 to 13%. That number has been treated as alarming by the bull community. The Japan retail premium at 60% is newer, less discussed, and far more extreme. The mechanism matters here. Japan's retail precious metals market is one of the most price-sensitive and sophisticated in the Asia-Pacific region. Japanese retail investors are not buying on speculative momentum. They are paying 60% above a published Comex benchmark, not because they believe silver is going to $150 next Tuesday, but because they cannot source the actual metal at any lower price. When a geographically dispersed retail market, one with no strategic industrial silver mandate, no government-directed accumulation, and no export restriction to cite, is pricing physical silver 60% above the paper benchmark, that market is telling you the paper number is structurally disconnected from the real cost of sourcing the metal it claims to represent. When two of the world's most sophisticated retail precious metals markets, Shanghai and Tokyo, are simultaneously pricing physical silver at premiums that defy logistics arbitrage, the problem is not logistics. And when that physical premium dislocation is happening simultaneously, with a Comex coverage ratio sitting at 13.4% on an active delivery cycle, the structural picture those two data points paint together is not the picture the $76 paper price is painting at all. Then comes the Fed chair transition, and this is where the data becomes almost novelistic in its sequencing. On April 29, 2026, the Senate Banking Committee voted 13-11 along strict party lines to advance Kevin Warsh's nomination as Federal Reserve Chair, the first fully partisan Fed Chair Committee vote in the panel's recorded history. The full Senate vote is expected the week of May 11th. Jerome Powell's term expires May 15th. Warsh chairs his first FOMC meeting June 16th and 17th. 4 days before that committee vote, on April 24th, The Department of Justice dropped a criminal investigation it had opened into Jerome Powell over cost overruns in the renovation of the Fed's Washington headquarters. Senator Tom Tillis, who had publicly vowed to block the nomination until the investigation was resolved, withdrew his objection immediately after the DOJ announcement. The executive branch opened a probe into the sitting Fed chair. The probe was dropped precisely when a Trump-aligned nominee needed a Republican holdout's vote. The result was the first fully partisan Fed chair vote in American history. That sequence has been documented. It is not editorial commentary. It is the factual chronology of what happened and when. Now connect Warsh to Silver. He has stated publicly that he does not fully trust the Fed's official PCE inflation measurement and has signaled a preference for the Dallas Fed trimmed mean, which currently reads approximately 2.3%, versus the official core PCE at 3.0%. If Warsh walks into his June FOMC meeting using the Dallas Fed trim mean as his operative inflation benchmark, the policy gap he inherits is not between a 3.0% inflation reading and a 3.5 to 3.75% rate. It is between a 2.3% reading and a 3.5 to 3.75% rate, a gap wide enough to justify a rate cut on day one, before he has been in the chair for 30 days. Before you finish this piece, do one thing. Drop a comment below this video. Not for the algorithm. The algorithm is not why this channel exists. Drop a comment because every person who reads those comments in the next week or the next month or whenever they find this video will see that this community was paying attention when it mattered. That comment section is a record of who was here. Leave your mark in it. The ADP Private Payrolls Report for April, released May 7, 2026, showed the private sector added 109,000 jobs, above Wall Street's consensus of 84,000, and the strongest private sector payroll reading since early 2025. Wage growth for job stayers came in at 4.4% annually. Job changers saw 7% gains. The Employment Cost Index for the first quarter of 2026 showed private sector wages rising 0.7%. But adjusted for inflation at 3.5% PCE, real annual wage gains came in at just 0.1%, 0.1%. Real purchasing power for the average American worker has effectively stalled. The ADP number gave Wall Street a reason to price a Federal Reserve hold. But the Bureau of Labor Statistics April non-farm payrolls report, scheduled for 8:30 Eastern on May 8th, publishes into the most extreme ISM prices paid reading in 4 years, a real wage gain of essentially zero, and an incoming Fed chair who has already publicly signaled he is watching different data than his predecessor. The ISM Manufacturing Employment Index is already at 46.4. Services employment held in contraction for a second straight month. If April non-farm payrolls print below 75,000, alongside prices paid at 84.6 and PCE at 3.5, that is not a risk scenario. That is the textbook stagflation confirmation the bears said could not arrive in a strong labor market, and it arrives simultaneously with a Fed chair transition of historic political character. Now take the institutional gold picture and run it through the ratio. Goldman Sachs holds its year-end 2026 gold target at $5,400 per ounce. JP Morgan raised its gold target to $6,300 in February and has held that target through 10 weeks of the Iran conflict. Both forecasts carry the same underlying premise. The Fed's inflation constraint is temporary and rate relief arrives. If gold achieves $5,400 against a gold-silver ratio of approximately 61, the implied silver price is $88.52. Against JP Morgan's $6,300 gold target, the implied silver price is $103.27. The first quarter of 2026 gold demand established a record quarterly valuation of $193 billion, driven primarily by investment bar demand, the form of gold held by institutional long-term buyers, not speculative flippers. Historical data shows that when investment bar demand drives a quarterly record at this scale, it precedes a sustained structural floor at higher price levels. When that gold floor sets at a structurally higher level, the gold-silver ratio becomes a mathematical transmission mechanism, a floor for silver embedded inside institutional gold forecasts that the paper market at $76 is currently not reflecting. The bear case deserves the same air it has always received here. A 37% drawdown from an all-time high is not a temporary setback. It is the magnitude of correction that has historically preceded multi-year bear markets in a significant percentage of commodity precedents. The ISM prices paid surge could force the Fed toward a hiking bias, not a cutting one. A frozen or hawkish Fed is a floor under the dollar and a ceiling extension above silver, not a ceiling removal. The Iran one-page memo cited by Axios on May 6th has not been signed. 2 prior Hormuz relief signals both reversed. Oil retraced, silver retraced. Kevin Warsh told the Senate Making Committee he does not predetermine interest rate decisions, stating a preference for the Dallas-trimmed mean in a hearing is not the same as switching the Fed's operational benchmark at his first FOMC meeting. And the DOJ investigation into Powell has been characterized by the courts themselves as legally obstructed from proceeding. Every one of those counterarguments is real, documented, and honest. But here is what the structural data says on May 7, 2026. Spot silver is trading in the $76 to $77 range. Gold spot is near $4,695. The gold-silver ratio sits around 61, compressed from 62.5 in a single session. The ISM Prices Paid Index just printed its largest 3-month surge in the series' recorded history. The Comex coverage ratio is at 13.4%, 6 consecutive periods below the 15% stress threshold, on an active May delivery cycle. Japan's retail market is paying 60% above Comex spot for physical metal. The incoming Fed chair arrives under a DOJ-cleared path and the most partisan confirmation vote in American monetary history. And the BLS jobs report drops tomorrow morning. The Comex is running 6-1, paper over physical metal. Japan is paying 60% over spot to hold the actual thing. The ISM just printed the largest 3-month prices paid surge in the history of the series. The new Fed chair is arriving under a DOJ-cleared path and a partisan vote this country has never seen before. The BLS jobs print drops in the morning. Every primary source behind every number in this analysis is public and verifiable. The Bureau of Labor Statistics, the Institute for Supply Management, the CME Group Daily Warehouse Report, the Senate Banking Committee record, the Axios report from May 6th, USA Gold's daily precious metals market report. Pull the documents yourself. That knowledge does not disappear when a channel does, or when a platform changes its economics. It belongs to you. Pay attention. Invest with logic, never with noise. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk tolerance.